All right, looks like we are live on the live stream show tonight. So the U.S. general stock market indexes are continuing to rally, continuing to go up. But we are starting to get more information from companies reporting the Q2 earnings about how bad the second quarter was. So the banks reported earnings today on Tuesday, July 14th. We had Wells Fargo and also JP Morgan. JP Morgan's earnings are looked at as far better than Wells Fargo's. JP Morgan, let me just pull up the Yahoo Finance. I think it says that they beat on revenues and earnings. So Q2 earnings and revenues beat estimates. However, they are reserving many billions of dollars, I think around $10 billion for credit losses. But in actuality, the reality of the situation with the commercial real estate bust is probably going to be more than that. We'll see what the Fed decides to do. But the main reason for this show is Wells Fargo Bank, which, as my Patreon account contributors know, my over 1,000 Patreon account contributors now, and growing quickly, know I've been warning about Wells Fargo Bank since at least February, maybe even sooner than that. Once I started to realize how bad the global pandemic was going to be, that the restaurants and bars and retail stores, bricks and mortar retailers, and now seeing the behaviors of a lot of business owners, that they're going to be leasing less commercial real estate office space. Their employees are going to be working from home more, or telecommuting, or at least having some freedom. As long as they get the work done, they can get the work done from pretty much wherever they want, at least at some firms, at least for part of the work week. And this is going to hurt commercial real estate. And as I've been talking about now for months, for at least 4 months now, and there's an in-depth article, and I've talked about this in past live stream shows a long time ago in the archives about commercial real estate problems, specifically Wells Fargo. Why? Because Wells Fargo Bank, not only are they guilty of a lot of fraud that has been featured in the Dirty Money documentary series on Netflix. There's only 2 banks that have entire episodes in the Dirty Money documentary series on Netflix, and that one of them is Wells Fargo Bank and the other one is HSBC Bank. But the reason I'm so worried about Wells Fargo Bank, and I've been warning about it for so many months, really, the article I think for Wells Fargo for my Patreon account contributors came out in February, I want to say it's February or March. And it's down a lot since then, as you can see there on your screen, is because of their commercial real estate loan book. Not only that, Frank Partnoy, who used to work on Wall Street, he helped design collateralized loan obligations in the 90s, I believe, and then he left Wall Street, and now he's a law school professor, and he writes financial books. He penned this article last month, and I talked about this on my most recent George Gammon interview, if you've listened to that, where Partnoy makes some pretty serious allegations against Wells Fargo Bank that not only do they are they hiding their collateralized loan obligation losses, that they hid it, I think on page 144 of their annual report, it was deeply hidden. Some of their some of their collateralized loan obligations, which are derivatives and stuff with leverage loans, toxic sausage of bad corporate debt. It's so bad it's not even junk bonds. That's how bad the collateral is. And then the other allegations that Frank Partnoy made are the off-balance sheet, the Enron style off-balance sheet, the special investment vehicle, and he alleges that Wells Fargo Bank has at least $1 trillion in toxic assets off-balance sheet, just like Enron, and that contains like leveraged loans, collateralized loan obligations. So the leveraged loans are what's being downgraded now very, very rapidly by the ratings agencies, and the leveraged loans of all different tranches. So there's like subprime and different credit ratings for all these different leveraged loans, and these are chopped up and stuffed, very similar to mortgage-backed securities and collateralized debt obligations from the last major financial crisis in 2008 and 2009. And those are stuffed, these leverage loans are stuffed into collateralized loan obligations. But the ratings agencies have started to rapidly downgrade these leverage loans. I think at least 30% of the leverage loans have been massively downgraded. They haven't all collapsed yet. So the collateralized loan obligations in the lowest tranche, the subprime tranche of the collateralized loan obligations, they haven't collapsed yet, like 80, 70, 80, 90% or to zero yet. But it's a ticking time bomb. And at some point, I suspect what will happen, the Fed will have to come in and buy these things, even though they're probably either worth 0 or 10 cents on the dollar or a couple cents on the dollar. the Fed is probably going to have to come in and buy them from the banks, like Wells Fargo Bank at 100 cents on the dollar to help Wells Fargo. One of my Patreon account listeners asked about his mortgage at Wells Fargo, and honestly, we don't know. The rules could change. My educated guess right now, if you have like a mortgage at Wells Fargo Bank, if you have a bank account at Wells Fargo, the FDIC will probably just get the Congress and the Fed to print it. So that'll be guaranteed. But the mortgages for a bank like Wells Fargo, if there is problems, I could see the Fed backstopping Fannie Mae and Freddie Mac. So I think that's a possibility. Again, I don't know. It's just an educated guess at this point. But there are clear problems with Wells Fargo Bank if after they announced earnings today and the stock is down, it was down 4.57% on announcement of the earnings. And just in the last like 4 or 5 months, the stock is down, as you can see there on your chart, 53%. That chart's from Tavi Costa, hedge fund manager of Crescott Capital. He's a very successful hedge fund manager. I've interviewed him on my channel. I think the last time I interviewed him was maybe March. It's probably time to get him back on in the next month or two, just to get an update. He's an amazing follow on Twitter. People are like, why would a hedge fund manager tell the truth? And it's like, this guy has a really good track record. He's just a good guy. He's hardworking. So I think he's being honest, because there are some hedge fund managers that are not honest. I think Tavi has a good track record. His hedge fund has won awards. Crescott Capital has. Okay, so let me read the Wells Fargo articles. Wells Fargo loses $2.4 billion in the second quarter, the first loss since 2008. Wells Fargo lost $2.4 billion in the second quarter, the first quarterly loss for the bank since the real estate crash of 2008. And yet, in spite of that, let me add the XLF, which is the Financial Select Sector Spider Fund, or XLF. That's like the ETF, the Exchange Traded Fund, that tracks the banks and Berkshire Hathaway and some insurance companies. That ETF is actually up pretty substantially. Let me just pull up the chart here in the last couple of months. Yeah, it's up substantially since July 9th. So it is rallying in spite of Wells Fargo, which is kind of surprising. Maybe people are expecting a bailout for Wells Fargo, although the share price of Wells Fargo is not reflecting a bailout yet, but maybe for the banking sector in general, they're expecting that. Because you would think if Wells Fargo has problems, it would start to cause counterparty problems, especially if it ends up being true about Frank Partnoy and that $1 trillion off balance sheet. If that is true, the equity price, the share price for Wells Fargo could get severely wiped out pretty quick, unless the Fed changes the rules, which is pretty common, unfortunately. I also did an article last week for patrons. It is extensive, going through different banking rules changes, and there's been a lot of rules changes for the banks really since February and March. And the latest two rules changes have been the FDIC, where they're not going to be reporting quarterly bank stress test results. So the FDIC is claiming that the data results are going to be, they're hiring like data firms and they're going to get real-time data tracking, but the experts I've talked to, whether David McElvaney and others, they don't really believe that. So the FDIC is claiming that, but a lot of people think that they're moving the FDIC reports that are going to talk about bank stress tests, are going to just hide them, and it's going to be stealth. So we'll see. It's still early, but you know what they said about how they've been releasing these quarterly bank stress test reports by the FDIC for a very long time. And the other rules change that the banks just got in the last couple weeks is to collateralize loan obligations and what can go into them. And remember, a few minutes ago, I talked about leveraged loans and how those are being downgraded and those are a ticking time bomb. So the first tranche of leveraged loans that are going to blow up are going to be like the subprime level, the worst collateral, the worst debt covenant type of leveraged loan that's in the subprime collateralized loan obligation. Well, the banks have gotten the rules changed now in the last couple weeks to where they can stick other things into these other types of assets, and I'm using air quotes, into these collateralized loan obligations besides leveraged loans. I think they're going to stick junk bonds in there. Who knows what else they're going to stick in there? I mean, at this point, they will change the people in power, and this is rule number one if you're new to my YouTube channel. Rule number one is the politicians, the central bankers, the people at the regulatory agencies, the technocrats, all the people with too much power over the economy, too much power over us regular people on Main Street, the Joes and Janes, they will change the rules. If things are looking bad, they'll just cheat. They'll move the goalposts. They'll just change the rules. So those are the two latest rules changes. FDIC looks like we're not going to get quarterly bank stress test results and what goes into a collateralized loan obligation, because the stuff that's going in is being drastically downgraded by the ratings agencies. I think at least 30% of the leveraged loans have already been drastically downgraded, and there's more coming. But we have not had big blow-ups in the collateralized loan obligations yet. To my knowledge, the Fed has not started buying these collateralized loan obligations that are blowing up at 100 cents on the dollar. I haven't heard it yet. Now, maybe they are secretly. I don't know. But the Fed's official balance sheet has been falling the last 3 weeks. But this is why I agree with Dr. Ron Paul. We need to audit the Fed. We don't know if they're actually decreasing the balance sheet. It's probably not decreasing the balance sheet. And that's probably why the dollar is getting weaker on the dollar index. So the dollar index is down. It's down substantially. It's a little above 96. My guess is the dollar index is down quite a bit because the Fed is not really reducing their balance sheet, even though they're telling people publicly that they're reducing their balance sheet. But we don't have transparency in government. We don't have transparency in the Fed. This is just how things are. So it's a guessing game. So maybe someone who has more information than we do, and that's why they're shorting the dollar. On the dollar index. Okay, let me just read the rest of the Wells Fargo article. Wells Fargo said it set aside an additional $8.4 billion for loan loss provisions. The money set aside to cover potentially bad loans, more than double last quarter's $3.83 billion, as the side effects of the global pandemic ravaged almost every aspect of its business. The problem with that is nowhere near enough. Wells Fargo has over $1 trillion in commercial real estate. In their commercial real estate loan book. And if you believe Frank Partnoy, they have hundreds of billions, if not $1 trillion, in commercial real estate mortgage-backed securities and leveraged loans and collateralized loan obligations off balance sheet in that special investment vehicle. So if they're only setting aside a few billion here, a few billion there, cutting their dividend, it's very insignificant. With the global pandemic now in its 5th month in the U.S., Wells Fargo said the number of loans that were 90 days or more past due jumped more than 34% from the same quarter last year, when they're not opening up fake accounts. Hopefully they stop that. Infections are at record highs in several states, and economies are shutting down again. Enhanced unemployment benefits for millions of people run out at the end of the month unless Congress acts, painting a potentially grim picture for the months ahead. Quote, our view of the length and severity of the economic downturn has deteriorated considerably from the assumptions used last quarter, said Chief Executive Officer Charlie Scharf. The bank set aside $3.83 billion for potential loan losses in the first quarter. Yeah, I know it sounds like a big number, but if the other experts that are talking about this with Wells Fargo, with the problems at the bank, if they're right, it's nowhere near enough. Which means that either Congress is going to have to step in and the FDIC is going to have to guarantee things for people's bank accounts, and Fannie and Freddie are going to have to guarantee people's mortgages, which means then the Fed is going to have to print and backstop all this, because the dollar is a world reserve currency and everyone's doing monopoly money printing with the magic money tree now. Wells Fargo said it lost 66 cents per share in the April to June quarter. Analysts surveyed by FactSet expected a loss of only 16 cents per share. The bank said its results were hit by losses in its portfolio of loans to the oil and gas and commercial real estate industries. Yeah, the big one is the commercial real estate. Because Wells Fargo, and I've been talking about this for a very long time now, over 6 months, they have the largest commercial. Wells Fargo has had the largest commercial real estate loan book for a very long time. And it was supposed to be safe. But now, here we are in a different type of situation with the economy, and bricks and mortar retailer and businesses having as much office space, and people going to restaurants and bars, a lot of them. I don't know. Not sure there's going to be the same, anywhere near the same types of customers and shops open. And if that's not the case, Wells Fargo is going to have a lot of write-downs. They're going to have a lot of problems in the months ahead. Because over the last, 3 months or so, there's been forbearance on residential, on car payments, on commercial real estate. people paying their rent. There's been force majeure clauses where some retailers have gotten, restaurants have gotten away with not paying the rent for a certain amount of time. Eventually, they're going to have to, though. The bank said results were hit by losses. Okay, I already read that. The division that lends money and provides services to consumers and small businesses also lost money. In the first full reporting period under the global pandemic restrictions, the San Francisco-based bank said it had revenue of $17.84 billion in the quarter, down from $21.58 billion for the same period in 2019. The results fell short of Wall Street expectations of $18.4 billion. Wells Fargo also said it would reduce its third quarter 2020 common stock dividend to 10 cents per share from 51 cents per share. It's a big dividend cut. The nation's biggest mortgage lender said its interest. Wells Fargo has big exposure to residential mortgages and commercial real estate loan book too. Nation's biggest mortgage lender said its interest income fell to $9.9 billion, down $1.4 billion from the first quarter. As if the current business environment wasn't difficult enough, Wells Fargo has been operating under strict federal guidelines limiting its ability to grow. In 2018, the Fed capped the size of Wells Fargo's assets after a number of beginning in 2016 with the uncovering of millions of fake checking accounts its employees opened to meet sales quotas. If you're not familiar with that, go to Netflix, go watch the Dirty Money documentary series. There's an entire episode on Wells Fargo Bank if you want to learn more about that. The Fed lifted that cap earlier in April as part of the federal government's payroll protection program because many of Wells Fargo's small business customers were getting shut out from applying. Shares in Wells Fargo fell nearly 6% in pre-market trading. That was earlier, before the market opened earlier today on Tuesday, July 14th. Okay, one more article on Wells Fargo. This is a Bloomberg opinion piece. Wells Fargo hits rock bottom. Can it get worse? By Brian Chapata. From today, July 14th. To get a sense of analyst expectations heading into Wells Fargo and Company's second quarter earnings results released on Tuesday, look no further than this backhandedly optimistic perspective from Credit Suisse's Susan Roth-Katz. A, quote, broken bank can be fixed. Okay, sure. The third largest U.S. bank by assets has been in turmoil relative to peers for years, ever since a 2016 fine for improper sales practices damaged the company's consumer-facing image. I don't know why they put image there twice, and helped spur Chief Executive Officer Tim Sloan to resign in March 2019 after less than 3 years on the job. What they didn't say is that the CEO who resigned got a golden parachute. I think he left with over $100 million to leave. The economic fallout from the global pandemic only made matters worse. Wells Fargo was in the unenviable position last month of announcing it would have to cut its third quarter dividend from 51 cents a share to comply with the Federal Reserve's stress tests. The only question heading into its earnings report this week was how deep. Some analysts warned the probability of no dividend at all was, quote, not zero. It wasn't quite that dire, although I expect that may happen at some point, especially if I am right about the commercial real estate bust that is coming in the next couple quarters. But it was especially if businesses that are actually doing pretty well, that have adapted, are closing their commercial leases. They're not renting office space. They're either downsizing and they have less office space, or they've moved more things online to telecommuting, so people can work in the cloud or telecommute. It wasn't quite that dire, but it was undeniably bad. Wells Fargo announced that it would drop its dividend to 10 cents, lower than the projection from Bloomberg's dividend forecast team of a cut to 20 cents and a mean consensus estimate of 30 cents. It was part of a report that disclosed the first quarterly loss in more than a decade, causing shares to tumble in pre-market trading. And again, this is the Wells Fargo Bank having problems. The XLF, which is the ETF, acts like Wells Fargo is not really having problems. Let me see how large Wells Fargo is in here. Wells Fargo isn't the largest. The largest ones are Berkshire Hathaway at 13.4% and JP Morgan 11.07%, Bank of America at 7.16%, Citigroup at 4.11%. So Wells Fargo is only the fifth largest. Okay, back to this article. It was part of a report that disclosed the first quarterly loss in more than a decade, causing shares to tumble pre-market trading. The results indicate the bank, whose stock price has declined by more than 50% in 2020, has nearly reached rock bottom. I do not think the bank has nearly reached rock bottom, because the commercial real estate loan book and potentially if Frank Partnoy is right about that special investment vehicle off balance sheet, the bank has definitely not reached rock bottom. The natural question, unless the Fed changes the rules and starts buying the stuff now and doesn't tell us because there is no audit and claims their balance sheet is contracting. The natural question is whether there's much more room to fall or if there's nowhere to go but up. On its face, a reduced dividend doesn't provide much confidence for investors, particularly when competitors like JP Morgan and Citigroup left theirs unchanged, yet it's unquestionably the prudent move with so much uncertainty about the trajectory of the economic recovery. More than a few onlookers argue that the Fed should have halted payouts across the board rather than run any risks that banks could find themselves undercapitalized. So the Fed is pulling all these levers. They're trying to shore up the banks. They lower the reserve requirements. I talked about this in the Patreon account article. I mean, they did a lot of this stuff in 2008 and 9 too, to get the stock market juiced again, to get the banks to start making loans and making money again. A lot of rules were changed. I talk about that in the article behind the paywall in the Patreon account from last week. And they're back to changing the rules again for the banks. There's been a lot of rules changes for the banks to try to help the banks so they don't collapse in the last 4 or 5 months. The same longer-term view holds true for the news last week from Bloomberg's Hannah Levitt that Wells Fargo is set to cut thousands of jobs starting later this year in the face of mounting pressure to reduce costs dramatically. And HSBC Bank, I think, is also firing like 35,000 employees at least, some insane number. Yes, that doesn't indicate much in a way of resilience in the face of an economic downturn, yet the harsh reality is it's also the largest employer among U.S. banks, with a workforce of about 263,000 and is much less efficient than its competitors as measured by ratio of compensation to revenue. As Levitt noted, Wells Fargo has only modestly reduced its staff over the past decade, in contrast to Bank of America, which shrank by some 80,000 employees. That's because Wells Fargo was growing very rapidly. They were selling the market this narrative, how well they were doing up until the frauds got caught in 2016. CEO Charlie, that's why they kept hiring more employees and building out more branches. Plus, they bought Wachovia. It was more of a shotgun wedding, I want to say, when they bought Wachovia. I'm not so sure it was voluntary. Let's just put it that way, because from the stuff I've read and the people I've talked to, like Bank of America was a shotgun wedding for them to buy Merrill Lynch. It was a shotgun wedding for JP Morgan to buy Bear Stearns, and I think it was a shotgun wedding for Wells Fargo to buy Wachovia. CEO, and that's what also, the shotgun weddings and just merging the banks that temporarily made things a little better, and then they did a bunch of other rules changes to help make things look better than they really were by March of 2009. CEO Charlie Scharf, who took the position in October and is developing changes to the bank's long-term strategy. Does that involve disclosing to shareholders they have a special investment vehicle off balance sheet? Because I've only heard Frank Partnoy talk about that one. And there's people that are saying he's lying. There's like regular bank analysts saying that Frank Partnoy doesn't know what he's talking about, that it's hyperbole. Has little choice but to take what Evercore ISI called a rip-off-the-band-aid approach. At this point, as an investor, it's obvious Wells Fargo comes with its own set of issues. It would be worse to see the bank's new leadership, especially someone like Scharf, who has a reputation as a cost-cutter, taking tentative steps to right the ship during a recessionary environment, and more like depressionary environment, rather than making the unpopular decisions needed to ensure it bounces back with the economy in the coming years. Like its peers, Wells Fargo set aside a huge sum. I wouldn't call it a huge sum, but in a fractional reserve banking system, maybe it looks big. I mean, in a fractional reserve banking system and the derivatives market being as large as it is, and the repo market and the euro dollar and dollar funding markets being as large as they are, $9.5 billion is basically a drop in the bucket now. I mean, that's a rounding error. In the derivatives market, that's nothing. Blowing away estimates for $4.86 billion and roughly 17 times the amount taken a year ago. That in turn creates bleak headline numbers that give management the cover needed to move ahead with sweeping job cuts and other long-term changes. Now, just because a company's stock appears cheap doesn't mean it's a good investment, nor is it an expensive one necessarily bad. Christopher Whalen wrote an interesting piece. I'm not going to read it now because I've been doing this show for, let me see here, almost 25 minutes. Christopher Whalen wrote an interesting piece. If you're not familiar with him, he is a bank, credit, and mortgage finance industry analyst that helped predict the 2008 financial crisis a couple years in advance. He has a really good track record. I've interviewed him a number of times on my YouTube channel over the years. He's also been on Hedgeye and Real Vision TV, a number of other places. He wrote this article yesterday called, "Are the banks a value tease or a value trap?" And I would call them a value trap. Because while the regular U.S. stock market indexes are rising, Wells Fargo Bank is struggling. So I think it's more accurate about the problems in the real economy we're seeing from Wells Fargo, the stock of Wells Fargo Bank, and what they're reporting. So I would say the banks, especially Wells Fargo Bank, are not a good value play. They are a value trap. Back to this other article, the Bloomberg op-ed. Not just because a company stock appears cheap. Now, just because a company stock appears cheap doesn't mean it's a good investment, nor is it an expensive one necessarily bad. Just ask shareholders of JCPenney and Tesla. Even after this round of earnings, Wells Fargo's path forward is murky at best. Quote, "We are extremely disappointed in both our second quarter results and our intent to reduce our dividend," Sharf said in a statement. I mean, it's just so ridiculous when you release that. It would be nice if they actually were honest, like, yeah, our commercial real estate loan book is large and we're probably fucked 6 months from now. Hopefully this video doesn't get demonetized since I dropped the F-bomb. Maybe 6 months from now. Who knows the exact timing on these things? Quote, "Our view of the length and severity of the economic downturn has deteriorated considerably from the assumptions used last quarter. Only Wall Street was assuming a V-shaped recovery. Pretty much everyone else was not assuming a V-shaped recovery. The only thing that is V-shaped is the NASDAQ and the Dow. Those are the only things that are V-shaped that have rebounded so strongly. Oh, and the gold price. At the most fundamental level, the company counts on capturing the spread between what it earns on loans and what it pays on deposits, referred to as net interest income. Chief Financial Officer John Shrewsbury said on June 10th that the metric might fall by 11% or more to $41 billion, to the range of $41 billion to $42 billion after dropping by 6% in 2019, more than it did for competitors. Okay, that's all. Oh, actually, no, there's a couple more sentences. Its second quarter NII, so net interest income, was $9.9 billion compared with $12.1 billion a year ago. So they have rapidly declining. Wells Fargo has been having smaller problems, I would call them cracks, for the last like 18, 24 months. So it wasn't just like the fraud being discovered in 2016. It was a one-time deal. I mean, the cracks have been getting larger from what it looks like now. And then the global pandemic, and now Wells Fargo's commercial real estate loan book is in jeopardy. There's no strategic initiative that can undo the Fed's near-zero short-term rates, nor lift 30-year mortgage rates from record lows, and the bank doesn't have Wall Street trading operations that can offset weakness elsewhere. But apparently they do have a lot of commercial real estate mortgage-backed securities, and they do have a lot of leveraged loans, and they do have a lot of collateralized loan obligations. Still heading into earnings season with shares at close to the lowest price in a decade, set a decidedly low bar for Wells Fargo to be clear. At first blush, it couldn't even manage to do that. But Sharf still has a chance to prove he's the right person to forge a path forward for the 168-year-old bank. A concrete plan with tangible financial targets might be enough to reassure investors that it's a long-term bargain in an equity market where few seem to exist. I do not think that Wells Fargo bank stock is a long-term bargain. I don't think Warren Buffett thinks that Wells Fargo bank stock is a long-term bargain unless the government is going to give him a sweetheart bailout deal like what Warren Buffett got with Goldman Sachs and General Electric in 2008. And Berkshire Hathaway owns a substantial amount of Wells Fargo bank stock. It's not one of their two largest holdings like Apple or Bank of America, but it's, I think, in the top 5. There's a few more articles I have about the banks and earnings. I'll put them below the video in the information and description section, along with the Christopher Whalen article if you want to read more about this. If you want to read a lot more about the rules changes for the banks that have happened, the rules changes that happened in 2008, 2009, some of the other currency swaps along the way to help the banks over the last... there's been a lot of currency swaps hidden for years now. It wasn't just 2008 and 9. Let me just put it that way. I go into detail about articles about this behind the paywall in articles over the last month or so for my Patreon account contributors. And in the recent rules changes that happened too. There's been a lot of rules changes for the banks, though, since February and March. Oh yes, almost 500 people watching, and I didn't even tell anyone to tap or like or smash the like button. I screwed that one up. I'm getting tired. Joseph said that I think he read my Patreon account article. He is glad he put options on Wells Fargo. 6 more weeks to expiration. Keep the red coming. Well, you got to be careful, Joseph, in my opinion, because we don't know what the rules changes are going to be. So, yeah, Wells Fargo, from a fundamental standpoint, they have a lot of problems, but who knows what the rules changes are going to be with the FDIC or Fannie Mae and Freddie Mac or with the Federal Reserve helping Wells Fargo Bank. Sonny says, holy shit, did he just say $1 trillion? Yes, I just said $1 trillion. If you read the Frank Partnoy article from The Atlantic over the last month, which I've linked to many times on live stream shows since it came out, he says in the article that there is a special investment vehicle off balance sheet like Enron that Wells Fargo Bank has. And now a lot of mainstream Wall Street analysts and bank analysts are calling him a liar. Super chat from Jonathan. Thank you for the super chat. Hi, between PSLV, SIL, SILJ, SLVP, which ETF do you think is the best to play silver to the upside? Silver Miners ETF. What is it? SILJ. The Silver Miners ETF would have the most upside because you're getting leverage with the mining companies. So you're getting exposure to the silver miners. The Silver Miners ETF is going to have the most upside. From a risk-reward standpoint, though, you're taking more risk, but the upside is larger, in my opinion. Okay, super chat from Animalia Nicole Chrysalis Nix. Thank you for the super chat. Before, during hyperinflation, what practical steps ought one take prior to or during said period to prepare? Any locations hit less by global debt? You know, hyperinflations occur differently. This is, if you were in Argentina during the hyperinflation, the rules that government and the central banks there put in place are very different compared to other past hyperinflations. So this is why I talk about rule number 1 and governments and politicians and bureaucrats and regulators and central bankers changing the rules, because you're going to have to monitor the rules. People want something easy. People want an easy solution to something. Someone on Patreon sent me like a 10-page email asking like all these crazy questions about metal storage and how to protect themselves, and there's no easy solution to protect yourself with all these different metal storage options. Okay, if these different governments change the rules enough, even $1,000 an hour consultant is not going to be able to give you a perfect answer, especially not for $5 a month what I'm charging to answer 10 pages worth of questions about metal storage. So you're going to have to, if you have a lot of assets, the governments and the central banker, well, not necessarily, yeah, the central bankers want to redistribute it, but the governments want to tax it. So politicians and the bureaucrats, if you have a lot of assets, they see you as, Doug Casey would say this, as a milk cow. So the solution, and I'm using air quotes, to politicians, and I was watching a video where the former mayor of Costa Mesa was talking about pension fund shortfalls, and he was talking about the current people that in Costa Mesa, the unions that want their pensions paid out because it was negotiated, their solution to everything is to just get everyone to pay higher taxes. So they're going to see anyone with assets as cows to be milked. So if you own real estate, if you own a house or a condo and you're paying property taxes, they're going to try to increase property taxes. Even in the bad economic environment we're in, Chicago's already talking about increasing property taxes. At least the mayor was last month. So back to hyperinflation, because I wanted to talk about the rules changes. So in Argentina, They changed the rules a lot. People in Argentina, if you speak to, and I would recommend, Anamalia, listening to, there's a lot of interviews all over YouTube from people talking about what happened in Argentina during their hyperinflation. So there was a lot of really smart Argentinians, and they thought that they were going to win the hyperinflation game, and they took out mortgages on real estate. So they thought that, oh, my mortgage is going to get wiped, and they're going to get to keep the real estate, and then when there's a new currency, they're going to be good to go. Everything's going to be great. That is not what happened. The government changed the rules, and anyone who had a mortgage, it was in the new currency. So they did not benefit from the hyperinflation. On top of that, anyone who had dollars in an Argentinian bank account was also, or other foreign currency, it was also screwed. I believe, if I remember correctly studying this, that the dollars in Argentinian bank accounts, if you had US dollars in an Argentinian bank account, they were confiscated and they were turned into the hyperinflating currency at a government exchange rate, not at the black market, the real exchange rate, the black market exchange rate. They were exchanged at the government official exchange rate for the Argentinian currency, and then people were screwed there too. So, you want an easy answer for hyperinflation? The truth is there's not. And you're going to have to pay a lot of attention to the rules changes. It sucks, but this is what's wrong with governments. I don't like any government at this point. They're all of them are different degrees of bad. So you're going to have to pay a lot of attention to the rules. If you have real estate, or you have cash, or you have gold and silver, or you have Bitcoin, the governments may keep changing the rules. Jim Rogers has said recently he thinks people will be made into criminals, that Bitcoin will be banned. So there is no perfect answer to dealing with hyperinflation, unfortunately. If you're a prepper, if you own land, if you are growing your own food, maybe vegetables and herb gardens, you have your own water purification systems in place, you might be good for now, but who knows if the politicians are going to change the rules. You're going to either have to pay attention to experts like me that are trying to keep track of this. I can tell you a lot of financial professionals are not keeping track of any of the rules changes, because I talked to some of them, and a lot of these financial professionals weren't even aware about the rules that have been changed for the banks over the last 4 or 5 months. So if the average person wants an easy answer to a very complex problem, I get this all the time. People want me to explain every single thing in much easier to understand terms. That's just not how everything is right now. Everything's really complex. But it does fit pretty well under stagflate and tax and lie. Because if Joe Biden wins the election, okay, the tax component of stagflate and tax and lie is going to go up a lot. And he's a big spender too. And he's going to misallocate trillions from all of his spending programs, with maybe carbon cap and trade and Green New Deal and all these other programs. So you're going to have to pay attention to the rules changes, because hyperinflation's played out differently. And most people got destroyed in a hyperinflation. For a certain period of time in the Weimar Republic, foreign currency speculation worked. And then I think it got banned. You became a criminal doing it. So people were doing it to survive. They were doing foreign currency speculation and foreign currency trading. And then it got banned. Anthony says, no easy answers these days. Indeed, exactly. People want easy answers. And unfortunately, I'm sorry to be the bearer of bad news, there's only more complexities. There's only more rules changes coming. There's only more complexities coming. This is what governments do. You have to study. If you study the history of governments and politicians, I don't know how people can be in favor of big government and politicians then, if you actually study the real history. Now, FDR is worshipped as a god, but if you actually looked as a demigod by all my history professors in college, but if you actually looked at his record, the man was atrocious. He was an atrocious president, one of the worst ones ever. He totally lied to get elected. All of the platform he ran on, he did the exact opposite as soon as he won. So you're going to have to pay attention to the rules changes. If you think you're safe now if you're an American citizen and you think you're safe with a bunch of crypto and owning a bunch of Bitcoin and only owning gold or silver, the rules might change. We don't know. People don't want to hear this. This is a harsh reality. The rules have already changed a lot in just the last 4 or 5 months. Look what the Fed has done. Shorting only worked for at most 8 weeks. Matthew says Jim Rickards' new book covers what Jason is talking about. Yeah, and I've read that book, and I've interviewed over 500 of these experts. And I take bits and pieces, and I study financial history. You're getting a fairly complete picture to the puzzle with me because I've listened to long interviews and read books from a lot of different perspectives. So historically, hyperinflations play out differently depending upon the rules changes the governments decide. The hyperinflation in Zimbabwe played out differently than the hyperinflation in Argentina, and played out differently than the hyperinflation in Weimar Republic, which also played out differently than the hyperinflation in Austria when Ludwig von Mises, I think, was there. Okay, well, that's enough for this live stream show. I want to thank everyone for listening. Thank you very much to my over 1,000 Patreon account contributors. It is growing very quickly. It is only $5 a month to sign up and take a look at the content behind the paywall. There's a price of an overpriced cup of mediocre coffee. And there are over 100 articles, audio podcasts, and technical analysis charts behind the paywall. There is a lot behind the paywall for only $5 a month. Thank you very much to my monthly PayPal contributors. There's still a few of you and people who tip me once in a while. You can do so through my website, or I also take one-time donations through. I also take donations through cryptocurrency. The wallets are in the information and description section below the video. But the bottom line before I wrap up the show, with the share price, Wells Fargo Bank, I've been warning since February. Commercial real estate loan book, and derivatives. So Wells Fargo Bank, big problems. We're going to have to see what the rules changes are going to be, what the regulators are going to decide, if Fannie Mae and Freddie Mac are going to help them out, have to help them out with their mortgages, if the FDIC is going to help them out with the depositors. But with a share price, Wells Fargo, as you can see there, Wells Fargo is looking in serious trouble. As you can see there on the stock chart on your screen.